Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's check out some of the stories we're following for you in the BNN Bloomberg newsroom. The U.S. ambassador to Canada, Pete Hoekstra, says America is open for business, but it's up to Canada to make a better pitch. He made the comments at the U.S.-Canada summit in Toronto today. He said Canada could play a strong role as the U.S. rebuilds its manufacturing sector, but Canada needs to come to the table with a compelling case across all of its resources. Hoekstra says a strong Canada benefits everyone.
We think a Canadian-U.S. business relationship is positive. We want a strong Canada, okay? We think a strong Canada across the board is good for the United States, it's good for North America, and it's probably good for the world.
Shares of Dollarama are rallying today. That after the discount retailer reported increased revenue and profit in its most recent quarter, beat expectations. In fact, Dollarama saw first quarter sales surge 21%, profit jumped 17%. The company says the quarter was driven by business in Canada with strong demand for consumables and general merchandise. Oracle shares continue to slide today, down 12.3%. Despite beating revenue and profit estimates, the software company's revenue was up by 21% in the fourth quarter, and it also raised its profit forecast for the year. However, investors seem to be showing concern about Oracle's plans to raise more money to finance its build-out of data centers for AI. Oracle says it foresees raising an additional $40 billion through debt and equity financing. And taking a quick look at the markets right now, you can see the TSX still up for the day, 0.68%. It's being led by consumer discretionary. Real estate, healthcare dragging it down the other way, but still for the day, it is up by 0.68%. South of the border. And everybody is in the green, albeit barely for the S&P 500, up by 0.14. And the NASDAQ, you can see, is up by 0.3 right now. We are watching shares of Dollarama today after it reported a first quarter beat and profit up more than $28 million year over year. Here to talk about that and other things moving markets, Kai Lam, Chief Investment Officer at JCIC Management. Kai, thanks as always for joining us.
Great, thank you.
Okay, Dollarama looking pretty solid.
Yeah, I mean, they had really solid results. They beat expectations. One of the areas that they beat were same-store sales of 5.6%. That was an acceleration from the last quarter. Expectations were around 3.5%. I think with higher inflation and higher fuel costs, the Canadian consumer is really seeing a better value proposition from stores like Dollarama. We continue to like it. It is a defensive business, but they are growing. They're growing about 50 to 60 stores per year in Canada. But they also have growth in Latin America with their 60.1% interest in Dollar City. And longer term, they're turning around a business they acquired in Australia. So continue to like this one.
Do you see any other MAs for it? Is that how you see their growth happening, or is it mostly going to be through expanding stores?
Yeah, I really don't see them acquiring anything in Canada. I think they really need to absorb and turn around the Australian business when the way they acquired the Reject store. So I don't see any M&A in the short term.
All right. And another couple of stocks we want to look at. Finning is kind of catching that ride, isn't it, with the AI build-out?
Yeah, Finning is the largest Caterpillar dealer, Canadian company, and they do have exclusive markets in Western Canada as well as Chile and Argentina and South America. So they are a big beneficiary of growth in mining, particularly for copper as well as gold. But also they benefit from oil sands mining. One of the things that we really like about this stock as well, because sales have been really strong in mining equipment the last several years. But they also, as they age, they will require more maintenance, more service, more product support, and that'll be kind of the next acceleration for these guys.
And any concerns about that, about with infrastructure, any slowdowns there, concerns about that?
I mean, some of the construction activity in some areas, still need to pick up, but But overall, their backlog of 3.8 billion is quite good and provides visibility. We also think that the medium term opportunity in data centers in Western Canada, will also provide some tailwind for them.
And the other one you're looking at right now, Taiwan Semiconductor. Can we call it old school?
Yeah, I mean, look, we still like the AI growth theme, and a lot of attention has gone into names that are farther down the chain in terms of the supply chain, but they've had such a really big run. Taiwan Semi, we continue to like them. They are the world's biggest emerging market company, and they produce about 2/3 of all the chips in globally as a foundry. But what we like about them is it doesn't really matter who's winning, share in terms of the best chips, whether it's NVIDIA, AMD, or Broadcom. They're going to produce it. And they're a company that's not expensive, generates high cash flows, high margins, high returns. So we like that.
And is there any competition on the horizon for them? Or are they pretty much a moat?
Yeah. I mean, so look, if you look at as I said, they have about 2/3 of the market for foundry. The next two biggest players is Samsung Electronics and Intel. But their operating margins at Taiwan Semi is approaching 50%. At Samsung, their foundry margins are low teens, and Intel loses money in foundry. So it's really hard to see them being displaced.
All right, I want to ask you about it because it's what everybody's talking about. SpaceX, the IPO coming out tomorrow. What are your thoughts on it?
It'll be interesting to see if the market can absorb it, because SpaceX is coming out with a market cap of about 1.75 trillion, and they're going to raise about 75 billion or a little bit more with a green shoe. But this is a company that had revenues of 4.7 billion in the first quarter and net losses of 4.3 billion. To put that size in perspective of the 75 billion to raise, last year the total IPO market in the U.S. was only 47 billion, so it's quite large. And so we'll see how well it gets absorbed. But it looks like they're going to allocate at least 20 to 30% to retail, which is higher than normal. So we'll see how that goes. What will be interesting to see is Anthropic and OpenAI also want to IPO later this year, and I think the last valuation for Anthropic was almost $1 trillion. OpenAI was around 850 billion. And both of them want to raise about 65 billion. So with all three together, we're talking $200 billion of IPO activity just from three companies this year. And that's a lot. That's more than 4 times the total market last year. So we'll see how it goes.
All right, let's talk a little bit bigger picture. Kuzma, Trump again saying that we're not really interested in it. We're not in a rush for it. And also the Gordie Howe Bridge, it was supposed to open this week. That's what we were told, and now that's been changed. Your thoughts on the impact that all this is going to have on the economy?
Yeah, so the delay of the bridge was supposed to be open on Friday, and then an announcement came that it was going to be delayed without a specific timeline. But the bridge is ready. It's all done. However, it would seem like it's politically driven on this delay. So there's not really much more news on that. With regards to Trump's comments on not renewing Kuzma, for July 1st. So if that doesn't happen, then basically it's still going to be in place for the next 10 years, but will require these rolling annual reviews. And that causes uncertainty if that happens, because, businesses have to make their investment decisions. And if they don't exactly know all the conditions, then that might delay and slow things down. And it's not positive for anyone within the agreement. The other issue is that, even though the arrangement still stays in place, parts of it, like auto parts, might threaten in terms of increased tariffs, and that could be an issue. So something to watch for, but there is some risk.
All right, we got to wrap it up there, Kai, but thanks as always for joining us.
Great, thank you very much.
Kai Lam, Chief Investment Officer at JCIC Management. Up next, we'll tell you why Alberta might be one step closer to getting another pipeline built. That is just ahead. Alberta's energy minister says the province has met with a Fortune 500 company to finance a proposed oil pipeline capable of carrying 1 million barrels of oil a day to Canada's west coast. For more on this, we're joined by Ian Bokoff of Bloomberg NES. And thanks very much, Ian, for joining us.
Thanks for having me, Roger.
All right. The meeting yesterday, what do we know about it other than there was a meeting?
Well, we don't know very much, but Brian Jean said that they had held talks with a Fortune 500 company to finance and build this proposed pipeline to the West Coast, which would be a very short list of companies who could take on a project of this scale. He did say that they would give, they've held talks with a lot of Canadian companies and would give Canadian companies and Indigenous groups priority in the building of this project. But obviously the government is open to anyone taking this on. He also didn't say firmly that they would have someone in place by July 1st when they submit the proposal. But indications are that the government is actively talking to the private sector to take this on.
All right, and of that limited group that might be interested in this, have any one of them openly expressed interest?
Recently Enbridge was on Bloomberg, and Enbridge CEO Greg Ebel, and he said that they would be interested in it. That's previously he said, Enbridge wasn't interested in a pipeline of this scale, but that's changed with the recent agreement between Canada and the Alberta governments. They're looking to really speed along the timing of this pipeline and create certainty for the industry to take it on. So there is some changing of the wind here in terms of companies possibly who could take this on.
Now, some oil industry execs, though, they've been pretty clear about how they feel about this and what's involved in getting this built. What are some of the hurdles they say are surrounding this pipeline?
Yes, well, Roger, the Cenovus CEO was pretty blunt on Tuesday this week. He called the pipeline project unfinanceable by the private industry because of the regulatory burdens, the regulatory hurdles that they face right now. He said also that the oil companies would have to spend so much money just to fill this million barrel a day pipeline. It was an extreme amount of money, and they didn't have it. So quite big hurdles that he was openly talking about there, despite the Canadian government and Alberta governments wanting this pipeline to get done. The industry would need to have to spend a lot of money to get it there.
All right, so what are the next steps then?
As Minister Jean said yesterday, they look like they're going to be meeting their deadline of July 1st to submit the proposal to the Major Projects Office. If they do hit that, then the federal government has committed to an October 1st approval deadline. And then after that, September 1st of next year, all federal permits would be approved and construction could start. Again, the big question is, who is the private sector proponent or proponents of this? Right now, it is the governments who are pushing this pipeline, and we'll have to wait and see who exactly will be A, filling the pipeline with oil, and B, who will be able to build it and operate it.
Okay, well, we'll have to wait and see what happens with that. Ian, thank you for joining us. Appreciate it.
Thank you very much, Roger.
Ian Bokoff from Bloomberg. Up next, Canadian education technology company D2L eyes international expansion and AI adoption as key growth drivers. John Baker, founder, president, and CEO of D2L, joins us after the break. Kitchener, Ontario-based D2L saw total revenue rise but net income fall in the first quarter. The education technology provider to K-12 higher education and the corporate sector says it's seeing growing adoption of its AI capability, increasing demand as well from global markets. Let's hear more now from John Baker, founder, president, and CEO of D2L. John, thank you very much for joining us today. Let's talk first a little bit about the EPS miss. What happened there?
So in our case, we have a bit of seasonality in terms of when we run our business. So overall, targeting very well for our guidance for the year, coming in around 15% EBITDA for this fiscal year ahead. So we're looking pretty strong on the EBITDA. We're also making investments right now in AI, really driving that as an opportunity for growth and seeing tremendous opportunity to open up new markets around the world. So we're balancing accelerating growth with making sure that our EBITDA continues to tick up over time. There's also a slight dip in the first half of this year because of two key things that are happening in the business. One's we're doing a big database migration that's now concluded. So the back half of the year, our gross margins tick back up again. And it's also those investments that we're making, having a small drag on the earnings in the first half of the year.
Okay, and how did you said the database migration is done? How did that go?
Really well. So we're quite happy with the results there. You should also see it in Q1 results where we saw about a 200 basis points tick up in terms of gross margin on the product. And we should see that continue in the back half of this year. And we've got a long roadmap of continued optimization. So feeling very good about our ability to hit our numbers for the year. And we've also put out an indication that next year we should see it step up again.
All right, and the investments you talked about, is that for the free cash flow, the loss of $16.9 million? Is that where that went?
So typically Q1 is always a seasonal low for us in terms of cash flow generation. It's just really working capital. So I wouldn't put too much into that. That should normalize in Q2 and get back to a really nice cash flow generation for us for the year.
Okay, and down in the U.S., you had some churn issues down there. How is that going on?
So US K-12 has been a bit of a headwind for us for the last couple quarters. We've now stabilized US K-12 client base, so feel very good about our look forward. That headwind should subside in Q2, and then going forward, we're actually putting up new logos. We're seeing good growth, and so it's getting back to our run rate business, if you will. And as a reminder, US K-12 is about 5% of our business, so it's not a big part of our growth story in the sort of the future. It's not a market that's growing as fast as higher education, corporate, or international for us at this stage.
All right, but you also saw some nice growth with the international markets.
Yeah, we saw upwards of over 17% in the quarter, and again, we're looking at opportunities now to open up additional countries in many markets like the Netherlands or Singapore or Canada or Colombia. We're now becoming the #1 learning platform that's being used in these countries. So we're pursuing aggressively work that we're doing in India and South Africa and different parts of Latin America. And we just opened up an opportunity to enter a new market in LATAM. We actually had to resize the venue 3 times over the course of the last month as demand for people wanting to come into that event to see what's happening continued to pick up over the course of the last month. So it's a really good indicator for good growth opportunities globally.
And is that your AI Lumi? Is that what's driving a lot of that interest? And tell us a little bit about that.
Yeah, so in our core market, we've got 3 main competitors that are all really legacy technologies. So we're the AI leader in our market. So bringing AI into education to make it easier for, as you can imagine, instructors to be able to create questions and assessments and assignments and build interactivity and engagement with learners, help them achieve more, better retention, better outcomes, better grades, all in a nicely scaffolded approach, which really has a big net benefit for students. And so that's very compelling. Our learning services group is also working with clients all over the world to cut the cost of developing new programs in half. So clients can either use that money to work on more programs and expand faster, or they can drop it to the bottom line for themselves. So, really compelling offering, very strong ROI. And so now it's about driving adoption within our client base. We're already seeing good attach with new clients. And so, yeah, I'm quite excited about the acceleration that we're seeing in revenue on AI.
Okay, I want to ask the $20 million share buyback plan. Where are you putting the value of the stock at with this?
So obviously we see a healthy IRR to do that buyback, well supported by the full board. We talked to a lot of shareholders over the course of the last few months, making sure that we were going in the right direction with that buyback, and we feel very confident that this is a time for us to show strength, buy back some shares, and obviously we hope to see a good return on that investment over time.
And now you did that. You had that offer from company. Is it 2717? Is that or 2717? How would I'm not sure how you pronounce it. In April, the partners there. Are you still considering it?
So we said very clearly back when they provided that offer that we would not consider it. We did not feel it was a viable bid. I've since talked to a lot of the different investors, and there was no support for that as an outcome. In our case, we're trying to build a world leader. When we are trying to build our company, we see an opportunity globally to become the #1 player for learning platforms in higher education. We're expanding really quickly in corporate. And so, we think staying public, even though the public markets might have a slightly lower valuation than private markets today, we think that over time that will correct. And that as a global leader, we should be public, and we should use the opportunity to become a stronger company through the transparency, through the additional controls, through the additional disclosures that we're doing. It shouldn't make us weaker. It should make us a lot stronger. And so we're big believers in the public market. We're big believers in making sure that our shareholders are rewarded over the long term. And so we're making those investments now to demonstrate that, including the SIB and all the other buybacks as well through the NCIB.
Okay, we have to wrap it up there, John, but thanks very much for joining us.
Thank you. Have a great day.
Cheers, you too. John Baker, founder, president, and CEO of D2L. Coming up, Coho Canada's leading financial technology company raises $130 million, now a step closer to becoming a bank. We will hear from the CEO after this. Canada-U.S. Trade Minister Dominic LeBlanc says the July 1st deadline to extend the trilateral trade deal between the U.S., Canada, and Mexico is not a cliff that everybody goes hurtling off if not met. Speaking at the U.S.-Canada summit, LeBlanc says integration of the North American economy has brought prosperity to all three countries. LeBlanc says he expects bilateral deals to be reached adjacent to CUSMA, and if the deadline passes, Canada will continue to do what's necessary to preserve the trilateral framework.
I would expect that we'll have bilateral arrangements between Canada and the United States, between the United States and Mexico, sort of adjacent to the trilateral framework. If those agreements resolve issues that all three countries are trying to resolve, I'm hopeful that we might at that point have the extension. But if not, we'll continue to do what's necessary to preserve the trilateral framework, which is in the interest of all three countries.
U.S. President Donald Trump is threatening to launch major strikes on Iran tonight and says the U.S. will take full control of its oil and gas industries, including Kharg Island, in the near future. The comments come as attacks continue between the warring countries, and the U.S. military continues to enforce its blockade of Iranian ports. Kharg Island is key to Iran's oil industry and sees 90% of its exports pass through it. We are watching shares of Transat AT today after its second quarter results failed to meet estimates. It's up by about 0.83% right now. Revenue came in below expectations, while adjusted profit also saw a decline. The airline operator says rising fuel prices caused by the Iranian war and flight suspensions to Cuba were key factors. It intends to apply for the new federal funding program to offset the impact of fuel costs. Transat has also implemented surcharges on new bookings to mitigate the impact. And a quick look at the markets. Nice little bump for the TSX this afternoon as we head into the afternoon, up by 1.26% right now south of the border. Green Day as well, and they are surging as well. Let's see what's fueling this. It's been quite the change in the last half hour. Look at the S&P 500. It's up by about 1.2, and the NASDAQ is up by about 1.6. Coho, Canada's leading financial technology company, has raised another $130 million at a valuation now of over $1.3 billion. What will it take for Coho to become a bank, and what are its plans to compete with the big banks? Joining us now is Daniel Eberhardt, CEO and founder of Coho. Daniel, thank you very much for joining us.
Thanks for having me.
All right, $130 million, a nice little addition there. Where did it come from, and where do you have it earmarked for?
Yeah, so notable new names to the business. The biggest one is Mubadala, which is a firm out of the Middle East, about $340 billion in assets under management, so tier one investor. So really excited about the balance sheet that they bring to this. So some folks out of the United States called Savano Capital. Toby Lutka personally invested. Another gentleman by the name Michael Linford, who's the CEO of a firm. So a bunch of new names, and then a lot of returning ones as well across Thrive and Portage, Hoop, the pension arm of Ontario. We also had Eldridge Capital and a number of others participate, BDC. So lots of insider support and lots of new names on the cap table as well. So we're really excited. two uses of capital. One of them is we're going to continue to grow the business. We have about 2.5 million Canadians on the product today, and are growing well, but we want to continue to expand in new product lines. And then the second component is we're reserving some of this capital to capitalize the balance sheet of a bank license that I'm sure we're going to spend some time talking about.
Absolutely. I just want to ask about having Luca and Linford. Is it just money, or are they going to be helping out as well?
It's always both with these folks. They're both very busy, as you can imagine, but just their trust goes a long way, and they're obviously they have a deep expertise in who they underwrite to, and so the credibility is super helpful. But they've built two of the most iconic businesses in the last 40 years, so we feel really lucky to work with them and learn from them.
And Mubadala, are any concerns, you think, when you go for the license, having foreign money invested in this, or do you think it strengthens it?
I think it strengthens it. I mean, there is a question of degree and influence, and the things that OSFI pays attention to in matters are much more a function of governance and making sure that folks have the appropriate interests. But we're still, the majority of our investor base is in Canada. And then from there, it's, the United States, and then there's Mubadala. And so you can imagine, you can do the math on a $130 million round. There's only 10% of ownership up for grabs here. And so split amongst all these parties, I think OSFI has comfort. But that being said, we're really excited about the relationship with Mubadala. They obviously have a really big balance sheet, and I would expect we'll continue to deepen the relationship with them. All
right. And let's talk about how much closer now. What's next for you for becoming a bank?
Yeah. So, I mean, this was certainly kind of one of the last big pieces of the puzzle. As you can imagine, when you're raising capital for this, investors don't want to underwrite to an uncertain bank license application, and you want to raise that money as late as you can in the process. So, we're getting very close. Out of respect for OSFI and the teams that are involved, we're not saying hard dates, but we're 4.5 years into a 5-year process, and I think that largely tracks with where we expect to get a bank license.
And so sorry, 5 years you said? You just cut there. You cut out.
Yeah, apologies. 5 years is about long when we filed this first application, 2021.
And so when do you see it coming to fruition? Then do you think is that 130 million? You think that's enough to satisfy those concerns, and you think when do you see it becoming finalized?
Yeah, more than enough to satisfy the concerns. Certainly meets all the balance sheet requirements that we have. We're in the very late stages, and it can be windy, but we're out of respect for OSFI. We're not putting any sort of hard deadlines on it, but I would hope that we'll have a bank license in the near term.
And what do you think when that comes? What will make you stand out from the big banks? How do you compete against them?
Yeah, I mean, the big thing for us historically is if you look at the big banks, they have somewhere between 30 and 100,000 employees. We have 250. Our cost to acquire users is a quarter of what theirs is. I think we roughly move 10 times faster. The big disadvantage we've had historically is that our cost of capital has been 4 or 5 times higher than theirs. And so, with this, I think fundamentally we should be able to really reduce our cost of capital on the order of 70%. And then I believe that organizations shift their org charts. And so because we've kept our costs so lean and so efficient, if we do our job well, we get to translate that into paying higher savings rates, lowering our cost to borrow. I think if we feel like we don't translate this bank license into the best bank account in the country, we failed in that regard. So we're working hard on how that actually manifests, but it will be a meaningful inflection to the product offering that we have today.
All right, and one of the things you're offering now is crypto. What are you doing with that?
Yeah, I mean, we think crypto is a really important asset class. It's not. We have a pretty boring approach to crypto, and I think that's the right way to think about crypto as more of an asset allocation strategy than sort of gambling and some of the more the not so good elements of that market. But because of OSFI and because we also want to do this the right way, we partner with our crypto. So we don't actually hold any crypto. It's facilitated with a partnership through a firm called Endax, who is Zero regulated. And so, you try and keep church and state apart here. And we don't want OSFI to feel like they have to underwrite crypto volatility swings. And as you can imagine, we don't really want to have to underwrite those. So most of the things that we think are really important, like cost of capital, building great technology, we do in-house. We don't think it's really important that we directly hold crypto on our balance sheet.
All right, Daniel, we have to wrap it up there, but thank you very much for joining us.
Thanks very much for having me. Appreciate it.
Cheers. Daniel Eberhardt, CEO and founder of Coho. Up next, we'll focus on how shifting trade patterns are reshaping exports, jobs, and leverage across the U.S.-Canada relationship. We'll get you more from the U.S.-Canada Summit. More than a year after the U.S.-Canada trade shock began, the relationship is entering a new phase as the future of CUSMA remains unsettled. That uncertainty is front and center after President Donald Trump said he's not looking to renew the deal and that the U.S. doesn't need Canada or Mexico. For the latest trade data, BNN Bloomberg's Lindsay Biscaya talked to Francis Donald, Senior Vice President and Chief Economist at RBC Economics at the U.S.-Canada Summit.
Economists don't know what's in the mind of the president or what'll happen next with the negotiations. What we do know is uncertainty tends to weigh on the economy. Business investment is starting to pick up in Canada for the first time in a long time. There's real seeds of those green shoots that are coming into play, but Canadian businesses need to know that Canada is investable and there's a future in play. There's enough information to go on that says that's going to be the case. The country has tons of resources. We've got a government that wants to develop the path ahead, and the data is looking a little bit better than it was 3 or 4 months ago. But on balance, uncertainty is bad, and the more clarity we can get on the U.S.-Canada relationship in the next 1 to 2 months, well, that's going to help. In the meantime, we've got to cross over this giant hurdle, and unless you're in the brain of the President of the United States, you don't know what's going to happen.
I wanted to talk about that a little more in terms of like just what prolonged uncertainty would do for business investment in Canada. Like, as you say, Canada's got a lot of good things going for it right now, but obviously the relationship that Canada and the US have had over the years is also helpful. So if we continue to see that prolonged uncertainty, what does that look like?
Well, listen, business investment in Canada has been, as former governor of the Bank of Canada called it, a serial disappointment. This is not a strength in Canada, and it was a problem even before U.S.-Canada relations started to create some tension between them. What's weighing against it? Well, enormous amounts of regulation that has to come through. Some would argue that the tax system has not been particularly favorable. There's a long list of factors that have weighed on business investment in the country, and those can be addressed, and we can see movement, for example, towards some deregulation that can support and provide some sort of offset in the meantime. So as much as we want to focus on U.S.-Canada trade being the most important economic story in Canada, it's up there on the list, but it's not the only story, and it's not the make or break on the Canadian economic narrative for the next 12 months.
Canada has reduced its reliance on the U.S., as you were talking about. Like, Canada's in a pretty decent place. Is this a lasting diversification, do you think, or is this because of what we've seen with gold prices? We've seen last year, Canada's gold exports, for example, to the U.K. were up. What is this actually?
Thanks for mentioning that, because yes, we have seen some reduced reliance on the United States from 75% of trade down to about 68%. A lot of that is actually that we had surging gold prices. Those have been really supportive to our stock market, but they've also meant we could offset some of the decline in the US over towards the UK. Gold prices have come down, so sometimes those shifts in prices change a lot as well. What's critical, however, is that our most important trading partner is the United States right now. And as much as that feels like a vulnerability politically to us, it's actually a good thing economically right now. Why? The US economy is doing quite well. It's been supported by things like AI. It's been supported by a very strong top 10% consumer. But now, particularly in the last 2 to 3 months, there's signs that that is even broadening into more cyclical strength in the US. That alone will be supportive to the Canadian economy. And maybe that feels a little bit like a 2005 type story. When the US sneezes, Canada catches a cold and vice versa. It's still true. This is still our most dominant, most important economic relationship. And so we should be happy about that right now, because we get to benefit from some of the strength that's coming through. That'll be really important for Canada in the next 12 months as we wait for some of these policy changes from the federal government to impact our economy later, 2027, 2028, and beyond.
You also were talking about jobs data, which you say told a surprising story both for Canada and the US in the latest numbers that came out for 2025. What did you see as the silver lining there?
Well, jobs data is looking a little less problematic than it was before, and our unemployment rate is healing in Canada. We might be down a net 24,000 jobs since the start of the year, but really critically, let's put that in context. Back in 2023, 2022, we had to create 60 to 70,000 jobs per month just to absorb all of the new folks that were coming in because of immigration programs. We had population growth. Now we're in a very different paradigm, which is that we have 25,000 Canadians that are retiring every single month, and we have population contracting for the first time ever in Canada. What that means is we don't need to create jobs right now because we don't have new inflows into our labor force. So that's why you have this strange situation where maybe you're losing jobs on the surface, but the unemployment rate is also improving at the same time. So how we interpret these numbers has to change quite a bit. When we look at the momentum behind Canadian job market, what we see is improvements on a go-forward basis. There are some groups that are disproportionately being hurt, particularly young people, especially 16 to 19, those looking for temporary jobs, summer jobs, part-time jobs. That group is being disproportionately hurt right now. Unemployment rates for those over the age of 50 or even those between 25 and 55, those are looking relatively stable. So we always want to know where we are. Where we are is okay, but not good enough. And where are we going? Well, we're going to a better place by the end of 2026.
I want to loop back around and talk once more about the ongoing trade war as we watch, for maybe CUSMA renegotiations to continue. You talked about the fact that really the areas of Canada that were hit hardest so far by the trade tensions we've seen between Canada and the U.S. is Ontario and Quebec. But you say BC could be looking at some darker times moving forward. What are you seeing for the rest of Canada in terms of impact?
Well, let's just pause and remind everyone, CUSMA doesn't expire on July 1st. It expires in 2036. This discussion that all three countries, Mexico, United States, and Canada, are having are about extending beyond 2036. So if we hear from any government that we're not extending, that doesn't mean extending right now. It means extending 10 years from now. So it doesn't look like, unless we see the United States withdraw from the policy, which requires 6 months' notice, and approval from Congress, this is not a discussion about this trade agreement disappearing in the next month. Now, you're right. Even though 78% of trade going to the United States is currently tariff-free, 87%, for reverse my numbers, 87% of trade heading towards the United States is currently tariff-free. There are sectors that have been really hurt here, steel and autos in particular. They're in southwestern Ontario predominantly, not exclusively. Then we have aluminum. Aluminum is withheld to a certain extent. Quebec produces 90% of the country's aluminum. The US hasn't been able to substitute away from it. But that fourth sector, lumber, well, their tariffs have been in play since the first Trump administration and went up in October. So that's another sector that maybe is lagging behind to a certain extent and that is still experiencing some pressures there. So we got to be careful here about the different regions that are experiencing challenges, the different sectors. There's not one trade story that tells everybody's narrative in the country right now. Some folks, some companies, some sectors in some regions are really struggling with the weight of this trade war, and some have been effectively not touched at all.
Lindsay was speaking with Francis Donald, Senior Vice President and Chief Economist at RBC Economics at the U.S.-Canada Summit. Still ahead, today's market movers with Bloomberg's Matthew Griffin. We got Matt coming up in a sec with the market movers, but we want to take a quick look at the markets right now because they are popping. Let's see those numbers, and I'll tell you why the big jump. We were looking at them before, and they suddenly turned. They were up, but now they're really up. And it's on a comments that Trump just put out on Truth Social. It says, based on the fact, there you can go. You can see how they've bounced up nicely south of the border, and TSX is the same. Here's what Trump had to say. Based on the fact that discussions with the Islamic Republic of Iran have been brought to the highest level of Iranian leadership and approved, I have, as President of the United States, canceled the scheduled strikes and bombings against Iran this evening. Discussions and final points have been in both concept and great deal approved by all parties involved, including the U.S., Israel, Saudi Arabia, UAE, Qatar, Turkey, Pakistan, Bahrain, Kuwait, Jordan, Egypt, and others. The naval blockade will remain in full force in effect until this transaction is finalized. Time and place of the signing to be announced shortly. And you can see the markets are reacting to that. And let's bring in Matt now and see how everything else is reacting. Matt Griffin, how are you, sir? Good to see you.
Roger, I'm doing well. How are you?
I'm good. And the markets are good right now on that news. Are some gooder than others or badder than others?
Yes. Well, Roger, we've got a few to talk about. So which one do you want to do first?
Let's do Oracle. It's been beat up all day, hasn't it?
Yeah. So I guess you felt there'd been a little too much positivity. So we could start with the negatives. Yeah, this stock still down about 12%, even after the pop we're seeing in the broader market, on optimism about the Middle East. And it's the same concern that has dogged Oracle for months now. The amount of money that the cloud computing company is spending on AI infrastructure. So Oracle just reported results, and they said that they spent $16.5 billion in capital expenditures in the most recent quarter. That's effectively a tally of how much money they're spending on data center infrastructure. It's the vast majority of that money. That's more than Wall Street expected. And that brought their total for the most recent fiscal year to more than $55 billion. The company had said it expected only $50 billion of CapEx. And of course, it's all well and good to pivot into running AI software as Oracle has. That being said, investors want to see revenue and they want to see profit flowing in as a result. Right now, that just isn't keeping pace. We did see a slight beat on revenue and a slight beat on profit in the most recent quarter, but not enough to offset these concerns. And if you look back to September, when the stock last reached an all-time high, it's lost nearly half of its value. You look at the market cap, about $400 billion has now been erased.
All right, but their bonds, though, rallying, as they said, their Oracle saying the company said it doesn't expect additional bonds issuance this calendar year. So I guess some good news going on.
Yes, a little bit there. Of course, there is the sort of balance sheet question for these hyperscaler companies. And so far, that has held up a little better than the stock story here.
All right. And Intel, though, it's up after a double upgrade at Bank of America on its CPU business.
Yes, so Bank of America raised Intel, the chip maker, to a buy rating. Previously, they had the equivalent of a sell recommendation. Intel doesn't make these AI-specific chips, the GPUs, but the traditional central processing units they make are still needed to run AI software, including and especially AI agents. So Bank of America sees them benefiting from that. And there's a few other things flowing into the stock move today. One of them, you talked about positives from Oracle. Well, it's a positive for the entire chip maker complex. It might be a problem for Oracle if they're spending too much money on AI, but that money has to flow somewhere, and then some of it's going to go into Intel's pockets. And then you also have that whole sector just rallying after all the recent weakness. So Intel up about 7% today and bringing its year-to-date gains back above the 200% mark.
All right, and I just want to get in about DraftKings being called maybe on a hot streak because of some help from Bernstein and his comments about the World Cup.
Yes, so DraftKings now in a third day of gains, up about 20% over that time frame. And Bernstein saying that the sports betting company is the best positioned to benefit from the World Cup in its sector. They, of course, run a sports book. They also now have a prediction market product. And Bernstein says they're going to draw in business because of an NBC Universal partnership, a Telemundo partnership, a Spanish language app. Of course, you also have matches being played in Mexico, so a large Spanish-speaking audience. And, it's a little bit of the same story that's boosted the stock earlier this week. You saw strength in their prediction market volumes on Tuesday. That kicked off the hot streak. So Bernstein saying that might continue as the World Cup kicks off.
All right, we're out of time. Who do you want to win? One word. Say the right answer.
Well, the U.S.
Canada. Boo. Bye, Matthew. Have a good one, sir.
Thanks, Drew. Thanks for having me, Roger.
All right, let's take a quick check on the markets before we go. The TSX is on a nice surge right now. And one of the big gainers, look at that. You can see it's up by almost 1.4%. Big gainers, Dollarama. Its shares are up nicely. Look at that, 9.5% on their report that was rock solid. And that wraps up this edition of Trading Day. I'm Roger Peterson. Thank you very much for joining us. Have yourself a great afternoon.